In this video, we are going to have a little chat about divergence trading. And if you don't know what trading divergences are, basically you're using price action and a trading indicator to find potential turning points in the market. Now, straight up, I've seen some information about divergences as a holy grail. But just because you find a divergence, it's not a guarantee that a shift in price is going to happen. But if you combine it with other information, it could be a decision maker for a trader. So what is it? Well, divergence is when the price goes one way and a trading indicator goes another way. And there are two main types of divergence. We have bearish divergence, and that's where price is moving upwards with a new swing high, but the momentum indicator, whatever you're using, MACD, RSI, momentum, it's moving to the downside. And seeing bearish divergence may have a trader at least considering a downside price move. Bullish, it's just the opposite. You're going to see a momentum indicator moving up while price is still heading down. And traders with short positions, well, they may want to manage the trade, and others may look for a trading position to the upside. So we know how the price moves. So what indicators can we use? And there are three main indicators that people are going to use: MACD, the RSI, and the stochastic. So let's cover each one. For the MACD, when I use it, I like to use a modified version called the 310 oscillator. And here are the settings that I use and how you can adjust those. And this is actually a pretty good setting for swing traders who are just looking to take advantage of one clean swing in the market, because that's what swing trading is. And I think it makes it a lot easier to spot diverging momentum. So here we are essentially comparing the peaks of the fast line and the peaks of price. So this is a futures chart. And from A to B, we see that price makes a higher high. The momentum indicator made lower highs from the C to D. So this indicates a market losing momentum, or a bearish divergence chart pattern. The opposite again would be bullish, where price would make a lower low, but the MACD in this example makes a higher low. And from here, price eventually dropped 5% from the highs to the lows, which are off to the right of the chart. You can't see them. The RSI, it's a popular indicator, and it's just another indicator we could use to spot divergence. And you're going to use it in the exact same manner you would the MACD. And this is just a 14-period RSI. And we're looking for bullish in this example. If you compare A to B, you can see that both are making lows. Over on the right, you compare C and D. Well, price made a lower low, but the RSI is making a higher one. And traders would look for a trading position using whatever strategy they use here. So now let's look at the stochastic oscillator. And keep in mind, I'm going to say that one more time, you're going to use all of these indicators pretty much the same way. And this example, the stochastics is 14, 3, and 3. And we see price from A to B made new highs. Go down to the indicator, from C to D, we have a lower high. And you can see that momentum came into the market. And then we eventually saw a 17% drop in price. Now, not all setups like this are going to result in adverse price moves. Sometimes we will see complete trend changes. Now, divergence, you're not always going to see it in price reversals. And oftentimes price will just transition into a range. So traders should consider other qualifications for a trade and not just divergence. So let's put together a simple trading strategy that you can kind of start testing right now. We're going to keep it simple. Well, what does divergence mean? It means a potential reversal in price. That's it. So the first thing we want is to have some reason that price may be ready to reverse. So keep that in mind. We want to look for specific points in the market. To have a strong reaction, we have to have traders that are in a long position if we're looking for bearish divergence. Candlestick analysis, where you look at the size of the candles, that can show you if traders are piling into longs. And what we want to have happen is for these traders to run for the exits once the new high fails to continue. That's going to power our trade. We also want to look to have a trigger that occurs, and that's going to help put the odds more in our favor of some type of movement in your direction, less false signals. All right, here's a simple strategy outline. Number one, keep your eye on points on the chart, such as previous reversal points, support and resistance zones. Second, look for momentum in the first leg up that you're comparing to add to the probability of a strong reaction. That's if we're looking for bearish, okay? Divergence. Use a trigger, a trendline break, reversal candlestick patterns. even multiple time frame patterns that will get you into the market. So let's take a look at a time frame here. This is day trading of platinum. Now let's break down each of these stages. Number 1, while this line represents the potential resistance, and as you can see by the large candle and the shadow on the left, we should be expecting a reaction here. The second one, this is momentum pushing the price higher and MACD making a high. This is the momentum that we're talking about that we want to see, the first leg momentum. At number 3, price breaks the previous high. The MACD puts in a lower high, and the trigger would be a break of the low of the candle that broke the previous high. Here's another example. The congestion zone, as you can see in the chart, it's off to the left. I just didn't add it on this chart because the chart would have been too small. So at number 1, like I said, there's a congestion zone to the left, as well as here we can see a double bottom showing support. At number 2, momentum shows up. It's obvious due to the candlestick formations into the break of support. Price makes a lower low, but the MACD makes a higher low, and that shows divergence is occurring. And number 3, the entry trigger is just a break of the high of the candlestick that broke support. That's simple. Now let's talk about regular divergence versus hidden divergence. And quite simply, hidden divergence is one that happens during a trending price move that signifies a trend continuation, while the regular divergence hints to a reversal of the trend. So as an example of hidden bullish divergence, price makes a higher high while it's in a trend, indicator makes a low. I pay absolutely no attention to hidden divergence because we only know that a trend is continuing when it continues. So I don't even bother with that. Stop losses and price targets, well, we're looking for reversals. So putting our stop at the pivot point of the reversal plus a little bit of a buffer, that makes sense. If the divergence is going to hold, we want to see price move in our direction and not reverse soon after entry. It might, and that would just be a higher time frame coming into play. So perhaps you think of using half of your normal risk profile on these trades. The price target can be a multiple of your risk. It can be a break of a larger trend line, price structure, or my favorite for a lot of things is using a trailing stop. Let's sum it up here, what we covered. Number 1, divergence is simply a reversal signal that happens when price goes in one direction, indicator goes in another direction. We consider 2 types. Bullish, when the price is moving down while the indicator is going up. The opposite is for bearish. We can use the MACD, Stochastics, or the RSI for our indicator, and look for this pattern as potential turning points. And make sure you use a trigger for your entry. It's quite simple. Any questions, pop them down below. Please hit subscribe, and we'll talk soon.